Welcome to the weekly market recap. Today is Friday, July 3, 2026. All right, let's dive straight into the chaos. The market pulled off a massive plot twist this week, leaving investors with serious whiplash. While the Dow Jones Industrial Average defied the gravity of the tech sector and marched right up to snag another historic record high, closing at a staggering 52,900, the tech-heavy NASDAQ Composite took a painful 0.8% bruising. Why the massive split personality? It all boils down to a shockingly soft June jobs report that completely flipped the economic script. Suddenly, Wall Street shifted gears from screaming about burning inflation to biting their nails over economic softening. This sparked a furious, healthy rotation out of overextended, highly priced artificial intelligence and semiconductor plays straight into the steady waiting arms of non-tech value and defensive stocks.
When you look under the hood at sector performance, it was an absolute field day for the forgotten stepchildren of the 2026 bull market. Defensive sectors completely crushed it this week. We saw utilities, healthcare, and consumer staples all booking spectacular gains of over 2% across the board. Financials and industrials also caught a massive bid as investors actively sought out safe havens with resilient earnings profiles.
On the flip side of the coin, technology and consumer discretionary were the clear punching bags of the week. The high-flying semiconductor space got absolutely slammed, proving that even the most powerful secular trends need to take a breather when the macroeconomic macro winds start shifting. Now check out the thermometer for market psychology because the vibes have officially shifted. The greed and fear index plummeted hard down to a frosty 32, firmly planting its feet in fear territory. Just a few weeks ago, everyone was drunk on the AI hype cycle, but a combination of cooling labor data and intense geopolitical noise has forced retail and institutional traders alike to pull back on the risk throttle. People are suddenly playing defense, which honestly makes perfect sense given the insane run we have had in the first half of the year. The absolute biggest atomic bomb dropped on the macro calendar this week was the June non-farm payrolls data, and wow, did it miss the mark. The U.S. economy managed to add a measly 57,000 jobs, falling off a cliff compared to the 113,000 positions that forecasters were expecting. To make matters even more nerve-wracking, the government drastically revised down the previous April and May job gains by a combined 74,000. Now, the official unemployment rate did edge down slightly to 4.2%, but don't let that fool you. It only dropped because a massive 720,000 workers packed up their bags and exited the labor force entirely, dragging the participation rate down to 61.5%. This cooling labor market instantly took a ton of pressure off the Federal Reserve to hike interest rates in July, but it opened up a whole new can of worms regarding a slowing domestic economy. Our second major macro story takes us straight to Washington, where the battle for control over monetary policy is getting incredibly spicy following a dramatic Supreme Court decision that blocked the immediate removal of Federal Reserve Governor Lisa Cook. The White House and its closest political allies are reportedly renewing an aggressive backdoor push to reshape the central bank's leadership. The administration is actively exploring alternative legal avenues to place hand-picked, ideologically aligned economists into key central banking roles, with a specific eye locked on the current leadership vacancy at the Atlanta Fed. Even though several Trump appointees have recently aligned with the consensus to keep interest rates steady, this ongoing political pressure is keeping institutional investors hyper-vigilant about the long-term threat to the Federal Reserve's sacred institutional independence. Rounding out the top three is the crucial action in the energy markets. West Texas Intermediate and Brent crude prices showed remarkable stability, hovering just slightly above levels seen before the recent geopolitical flare-ups. This commodity calm comes right on the heels of the latest virtual OPEC Plus ministerial summit. While the expanded oil cartel technically agreed to raise official production targets on paper, internal energy tracking data for the month of June revealed that actual physical oil output among core Middle Eastern producers has dropped.
Traders are also keeping a razor-sharp eye on Tehran as the official state funeral ceremonies for Iran's former supreme leader run all the way until July 9th, meaning any sudden foreign policy declarations could instantly inject fresh volatility right back into global shipping lanes and energy supply chains.
First up in our S&P 500 spotlight is Meta Platforms, which stood out as an absolute beacon of green in an otherwise bloody week for mega-cap tech. Meta shares soared after the company announced an aggressive, high-profile partnership to expand its specialized AI cloud infrastructure. Wall Street absolutely loved the bet, recognizing that while other firms are facing slowing hardware demand, Zuck is doubling down on enterprise monetization strategies that could yield massive margin expansions. It proved that if you have a clear blueprint for artificial intelligence profitability, the market will reward you handsomely. Next up is the poster child of the AI revolution, NVIDIA, but this week it was for all the wrong reasons. NVDA acted as the primary anchor dragging down the broader technology sector, experiencing a significant multi-day sell-off that triggered a cascading pullback across the entire semiconductor landscape. The Philadelphia SE Semiconductor Index took a serious hit as institutional funds systematically locked in massive year-to-date profits. This wasn't necessarily a fundamental breakdown of the company's chip dominance, but rather a classic valuation reality check as macro fears took center stage. Closing out our S&P 500 movers is Alphabet, which experienced a historic milestone this week. Google's parent company officially logged its very first trading sessions as an elite member of the Dow Jones Industrial Average, formally replacing telecom giant Verizon. Investors celebrated the corporate reshuffling by bidding Alphabet shares up an impressive 5% on day one. Joining the price-weighted index forces a massive wave of passive institutional fund rebalancing, giving Google a beautiful structural tailwind right when the rest of big tech was fighting off aggressive sellers. Moving over to the small cap arena, the secular rotation into the Russell 2000 gave a massive boost to speculative biotechnology names, and Viking Therapeutics was leading the charge. VKTX caught a monstrous wave of buying volume as investors looked for high-growth alternatives entirely detached from the slowing macroeconomy or tech hardware cycles. With cash flooding out of mega caps, nimble clinical stage small caps with strong balance sheets and promising pipelines became the ultimate playgrounds for aggressive alpha-seeking traders. Talk about an absolute roller coaster. Biomea Fusion became one of the single most heavily discussed and traded small cap tickers on the block this week, experiencing jaw-dropping double-digit percentage swings. BMEA became the target of an intense retail-driven short squeeze following updated data releases and shifting analyst sentiments. When the small cap index catches a bid, these heavily shorted, low-float clinical names can gap up with ferocious speed, highlighting both the immense profit potential and the extreme danger hidden within the small cap landscape right now. Rounding out our small cap coverage is Marathon Digital. Crypto miners have historically traded like high beta tech stocks, but this week Mara staged a fascinating divergence. Even though chip designers and hardware giants were getting systematically liquidated, Marathon managed to find a firm technical floor. The stock stabilized and bounced as underlying digital asset prices refused to break below critical psychological support zones, offering small-cap traders a unique tactical vehicle to play asset resilience without touching the bruised semiconductor sector. Taking a look at the weekly chart for the S&P 500, Proxy SPY closed virtually flat, finishing the week around the $748 mark. Technically, the index is showing a highly constructive consolidation pattern despite the heavy tech liquidations. On the downside, the absolute line in the sand for the bulls sits as a strong support zone at $730, aligning with recent structural breakout points. On the overhead flip side, if the value rotation continues to build momentum, look for the bulls to retest heavy psychological resistance up at $755. The NASDAQ 100 proxy, QQQ, paints a much more cautious defensive picture on the weekly time frame. The heavy chip sell-off dragged the ETF down to close near $516, placing it uncomfortably close to its crucial 50-day moving average. Technical traders are watching this area like hawks. If the tech rout intensifies, look for next major support to step in near the $510 level. To completely invalidate this short-term bearish momentum, QQQ needs a powerful volume-backed push back above structural resistance at $530. The absolute chart of the week goes to the small-cap champion IWM. The Russell 2000 proxy completely decoupled from tech weakness, surging upwards to print glittering new highs as the equal-weighted market breadth vastly improved. IWM has established a beautifully firm, rock-solid support floor down at $220. With the technical breakout officially confirmed on the weekly close, the path of least resistance is pointing straight up towards significant psychological resistance at the $240 level. Shifting over to the digital asset frontier, Bitcoin put on an absolute masterclass in technical resilience. Despite a brutal macroeconomic environment and a savage equity liquidation across tech hardware, BTC stubbornly refused to buckle, holding on to its vital technical and psychological support floor right around $60,000. Market analysts are incredibly encouraged by this behavior, noting that if Bitcoin can successfully build a long-term macro bottom here, it could officially break its historic, painful 4-year cycle of 80% drawdowns as the asset class matures into institutional adulthood. Not to be outdone, Ethereum displayed a highly impressive amount of relative strength over the last 7 days. While underlying smart contract protocols and tech ecosystems were dealing with intense selling pressure in traditional equity wrappers, ETH held its ground beautifully. Technical support is firmly locked in around the $3,300 zone, and capital inflows show that long-term accumulation is keeping the asset well insulated from the short-term panic shaking the equity options market. Meanwhile, the broader altcoin market experienced a highly fragmented, mixed performance as it waits for a definitive macro cue. Total altcoin capitalization remained largely unchanged, but underneath the surface, we saw a fascinating mini rotation taking place. Heavily overhyped meme tokens and speculative Layer 1 protocols saw notable capital outflows, while decentralized finance applications and real-world asset tokenization projects caught a solid bid, mirroring the shift toward value and utility that we are seeing in traditional stock. As we pack up our charts and head into the weekend, the overarching market sentiment can best be described as cautiously bullish. Yes, the tech sell-off is painful if you're over-indexed into semiconductors, but the massive improvement in overall market breadth and the explosive breakout in small caps prove that this bull market is healthy, expanding, and far from dead. Capital isn't fleeing the system entirely. It's simply moving into more defensive, attractively valued pockets of the economy as rate hike fears completely evaporate. Looking ahead to next week, the economic calendar is absolutely packed with market-moving catalysts. We are officially kicking off the summer corporate earnings season with heavy hitters like PepsiCo, Delta Airlines, and Fast Retailing stepping up to the earnings plate to give us a raw look at consumer health. On the geopolitical stage, all eyes will be locked on Ankara as President Donald Trump attends a highly anticipated NATO leadership summit, while global markets continue to closely monitor any policy shifts out of Tehran. Smash that like button, subscribe for weekly breakdowns, and we will see you next time.